Welcome to the FedLife podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
Hello and welcome to all my Feds, to this episode of the FedLife podcast. Once again, I am your host, Dan Sipe. Additionally, I'm the branch manager here at Serving Those Who Serve and Sipe and Associates. I will begin as I always do. I want to say thank you for taking the time to listen. And above all, thank you for your service. You don't hear it enough, especially during the current pandemic. You are doing so much to keep everything running, and everybody should be thanking you. But if they are not, allow me to do it for them. We are back today, remotely still. And if you are remote, that's good. Stay safe. If you are back in the office, stay even safer. We are back with the guru, the incomparable Ed Zurndorfer, as part of our ongoing mission to reach, teach, and serve you. And at the outset, as I always have to, I need to say the opinions of our guest, Ed Zurndorfer, no matter how awesome they are not the opinion of Raymond James or Serving Those Who Serve. This podcast is presented for information only and not intended to be taken as advice. All listeners should consult their personal advisors before taking any action. And as is our wont, these podcasts will mirror Ed's FedZone articles that you can find at blog.stwserve.com or at fed-zone.com. We have a new look. By all means, get there and check it out. Let me know what you think. Now, all levity aside, all kidding aside, all fun and games aside, this topic we're about to cover is really important. And folks, I need to ask you, the folks that are regular listeners, we see you out there, we thank you for that, need you to share this one, because this could really make a difference for a whole lot of people. As you may be aware, the president issued a presidential memorandum directing the Secretary of the Treasury to defer withholding and deposit of payroll taxes, which on the surface sounds great, no taxes. Well, it's a little more complicated than that, and that's what we're here to talk about, and how this will affect you and how you actually need to prepare. So, Ed, for starters, let's go with a little bit of background. This is part of the president's authority to do so, correct?
The president can defer, ask the Secretary of the Treasury to defer taxes on employee paychecks, not get rid of the tax. I want to emphasize that. Not get rid of it permanently, it's just deferring them. They will be paid, but later. That's what deferral means. So what is happening here, Dan, is that federal employees between September 1st, certain federal employees, we'll get to the specifics here in a moment, certain federal employees are not having withheld from their paychecks the FICA, that's the Social Security tax, their portion of the Social Security tax between September 1st, for all pay dates between September 1st and December 31st. Now, the FICA tax is 6.2%, 6.2% of their what's called Social Security wages. Mm-hmm. And the employer, in this case the federal government, as many people know, matches the employee contribution. So the employer puts in 6.2%, matching the employee contribution. And so for federal employees, these eligible employees are not putting in the 6.2%, but the federal government is. Their portion is still being put in to the Social Security Trust Fund.
Got it. Okay. And from reading your article, it's optional for a lot of employers to go ahead and do this, but that's not the case with the federal government in this case.
That is correct. When this memorandum came out in early August, it was very clear that an employer does not have to adopt this tax deferral of FICA taxes. In fact, most big employers have not done that. I was reading an article in the Wall Street Journal. Most of the big employers in this country, like take a company like CVS, they decided they're not going to do it. On the other hand, President Trump said that all federal agencies will implement this tax deferral of the FICA tax. Members of the uniformed services also will have the FICA tax also deferred on their paychecks between now and December 31st. I emphasize it is a deferral. This is not a gift. This is a loan, because as we're going to find out here in a moment, this has to be paid back. So employees might be very happy now if they see more in their paychecks, but they're going to see less in their paychecks come January. We'll talk about that also in a few moments.
Gotcha. And the feds themselves can't opt out of this, correct?
A federal employee cannot say to their HR or payroll office, I don't want to participate in this. I choose not to have this tax deferral. I want you to take out the 6.2%. Of course, you realize that this is only for employees. We didn't mention who it's for. It's for any employee earning less than $104,000 during 2020. This is their SF Standard Form 50 salary. That everybody has an SF50 and shows what their 2020 salary is going to be. So if it's less than $104,000 this year, then they're going to have the 6.2% not withheld from their paycheck during these 4 months. Now it's actually you have to be a little more specific here. Since employees get paid, there are 26 pay dates. If you divide 104,000 a year by 26 pay dates, that means if an employee's gross salary is less than $4,000 in a given pay date, then the FICA tax will not be taken out of the employee's paycheck. But this is going to create a whole bunch of other questions, which we'll also talk about here in a few moments.
Got it. Okay. And, you just touched on that. You highlight that there are certain salary levels and how they're affected in the relevant dates. So why don't we dig in a little bit further on that? Because you draw the distinction between below 104 and above 104. Why don't you talk through that a little bit?
Okay. So employees should be aware that the Social Security taxes, the FICA tax, is being imposed on what is called their Social Security wages. Their Social Security wages. There are three types of wages here when you look on a W-2. There are three wages if you look on a W-2. In Box 1 are the taxable wages. Box 3 are the Social Security wages, and Box 3 are the Medicare wages. A federal employee who is enrolled in the federal employees' health insurance, and many are, employees pay on average 25 to 28% of the the health insurance premiums. Those premiums are deducted from an employee's gross salary before all taxes: federal, state, Social Security, and Medicare Part A. So let's take an employee who's earning let's say on their SF50 it says they're earning $108,000 a year. $108,000 a year. And the cost of their health insurance, they're paying $2,000 a year for health insurance.
Okay.
That means that their taxable wages, Dan, are reduced to $106,000.
Gotcha.
It also means their Social Security wages are reduced to $106,000, and their Medicare wages are reduced down to $106,000. Now we're down to $106,000. So this employee on the surface would not be eligible for this tax deferral because their wages for the year are $106,000. But hold on, we're not done yet. Many employees are enrolled in the federal dental and or vision insurance.
Gotcha.
Those premiums, the employee pays the entire portion of those premiums. The government doesn't contribute anything to the cost of dental vision insurance. So let's say the same employee who's paying $2,000 for health insurance premiums also has vision insurance and is paying $1,000 a year for vision insurance. So now the taxable wages are now down to what? $105,000.
Gotcha.
Social Security wages down to $105,000. Medicare wages down to $105,000. We're still not done. This same employee also contributes to the healthcare flexible spending accounts, the healthcare FSA. Those contributions that the employee makes are also deductible for all taxes. And the employee puts in $2,000 to his or her healthcare FSA. So now the taxable wages are down to $103,000. The Social Security wages are down to $103,000. So suddenly we've gone from $108,000 total gross all the way down to $103,000, and this employee would have the tax deferral of their FICA taxes this quarter. So you just can't look at the gross salary entirely. You have to look at what benefits you have and and the cost of those benefits to arrive what is called your Social Security wages.
Gotcha. Now,
somebody may look at their SF50. Oh, I'm not going to have it. I won't be eligible for this because I'm earning $108,000 this year.
Sure.
Well, in fact, you might be, because you got to look at what if you have health insurance, dental, vision insurance, flexible spending accounts, because that's all taken out. Before all taxes.
And
one thing else I want to point out, that anybody who contributes to the traditional TSP, contributions made from an employee's paycheck to the traditional TSP, are taken out before federal and state taxes only. They are contributions that are made to the traditional TSP are subject to Social Security and Medicare tax. So contributing to the TSP is not going to reduce your Social Security wages.
You read my mind, brother, because I could hear the folks with their earbuds in starting to raise their hands to ask the question, what about TSP? So I'm glad you covered that. And again, the thing we need to stress here is this is a deferral. So one of the things you put in the article is that what is deferred between now and the end of the year is actually slated to be paid back within the first quarter of the new year, correct?
Dan, I like how you said this, is slated to be. There is not a lot of guidance on this yet.
Ooh.
Many members of Congress are asking the Secretary of Treasury, well, how's this going to be implemented? How are they going to pay it back? Supposedly, and I emphasize the word supposedly, starting with the first pay date in January 2021,
mm-hmm.
and between the first pay date in January 2021, and the last pay date for April 30, 2021, all the money that was not withheld during this last 4 months of the year will be withheld equally from each pay date during the first third of the year of 2021. It'll be taken out in addition to the regular FICA tax that's taken out of their wages that they're earning during 2021. So they're going to have much less in their paycheck in 2021, for starters, than they really anticipated, because
Gotcha.
they're going to make up for what was not taken out during the last 4 months of 2020.
Gotcha.
And I just have a suggestion for employees. This is what I really recommend, Dan, that employees, with the extra savings they get, please put it into a savings account, set it aside, because it's going to have to be paid back. You have to anticipate that this money is going to have to be paid back. Now, President Trump had proposed, well, maybe we should just forget about it and then just say it's going to be just a gift. They don't have to. The employees will not have to pay that. It's not going to happen, Dan. Not going to happen, because the Social Security Trust Fund is in such, is slated to go under, for lack of a better word, by the year 2034. They're talking about if things are not done to beef up the Social Security Trust Fund, significant cuts in benefits will occur as early as 2024.
Gotcha.
That's only 4 years away. So
Gotcha.
Doing something like this to forgive these FICA taxes, just to say they don't have to be paid, will put a big dent in the Social Security Trust Fund. So I highly doubt it's going to happen.
That makes sense.
So employees
Now,
should look forward to paying it back.
in your and you actually have a pretty good hypothetical here in the article, so I'd like to just buzz through it a little bit. Ed assigns random names to people, so if you hear your name, he's not talking about you. I just want to be clear about that. So we have the hypothetical Carla. Her gross salary is $100,000. She has FEHB deductions of about $2,200 a year. She has the healthcare spending account deductions of about $2,700 a year. So her biweekly gross pay would definitely have her under that $104,000 number.
Less than $4,000.
Yep.
Yes.
So
less than $4,000. Mm-hmm.
Yep. So what you touch on here is that Carla is going to have 13 weeks of more money, and then again, based on the way you slated that's going to double up on her in the next quarter. So at any point in time, and stop me if I'm way off base on this, anything that's deferred, if this is the way it ends up, is only being deferred for one quarter, correct?
That is correct, because it's my understanding that come May 1st next year, if this individual does not pay back whatever they owe, the IRS will send out a notice that this is what you owe, and they're going to charge interest on the balance.
Wow.
So,
I'm sorry, that stinks.
Well, again, it stinks in the sense it's not going to accomplish anything.
Gotcha.
In my opinion, it's because people really can't spend it unless they have a lot of extra money extra liquid money to knowing they're going to have to pay it back.
No, I got you. Now, what I really want to dig into, and folks, please, this is in the Fed zone. Just go in and in our search bar, search Social Security tax Halt, and it's going to come right up for you. Our guy Benefits Ben has done a really good job of making that all really easy to search. But you bring up a couple of things for some hypotheticals with the hypothetical Carla, which is, what if the hypothetical Fed retires on December 31st? So why don't you talk about that?
Okay. If, let's say, a federal employee retires on December 31st, it's a very popular retirement date, as you know,
Sure.
Dan. A lot of people like to retire at the end of the year. And that means that as of January 1st, 2021, they'll no longer be on the payroll. Mm-hmm. They're retired. No more paychecks. How is the money going to be paid back then? Because we just said that it's our understanding that that this employee's payroll office will withhold whatever was not that was deferred during this last 4 months of 2020. Well, the employee is not getting a paycheck, so how's it going to be paid back? Some are saying in the administration, well, the agency they can pay the agency before they retire. They'll pay it back entirely. I have some other ideas here. And I point this out in the column. Well, if they retire December 31st, they're still going to get at least one, maybe two paychecks from December, because those paychecks will be dated in January. Mm-hmm. If somebody retires December 31st, they would have worked all of pay period 25. Pay period 25 this year ends on December 19th, so they're probably going to get paid in the first week of January, and pay period 26 ends on January 1st. So that paycheck will definitely be in January. The agency could take all this owed out of those last two paychecks. It's possible. It's possible. That could be a lot of money, though. Somebody may not have enough of a paycheck to cover the liability.
That's a crummy retirement gift. Sorry.
Another possibility is they'll take it out of the retired employee's lump sum payment for unused annual leave. When somebody retires from federal service, any unused annual leave they have is paid to them in a lump sum payment. That lump sum annual leave payment is subject to federal, state, and Social Security and Medicare Part A payroll taxes. They could take whatever's owed out of the lump sum annual leave check. So these are some possibilities. The retiring employee will pay the agency what is owed before they retire. They'll take it out of their last one or two paychecks, or have it taken out of their lump sum payment for unused annual leave. I also want to point out that if an employee leaves federal service during this quarter, suppose they leave in November, go into work in private industry, they do get paid for their unused annual leave. Also, they'll get their last paycheck. So it's possible it could be taken out of that. I don't know if the computers can be programmed for that, the payroll office computers, or they'll just be billed before they leave. This is what you owe us before you can leave federal service. I'm just throwing out some possibilities here.
Wow.
There's no official guidance here.
So we have to set up. If you want to leave, we have to set up a toll booth before you can go. And again, folks, I'm not trying to be flippant here, but I'm trying to keep it a little bit light because I've lived in the real world. I've been blessed to serve you all for close to 35 years, and I've met people in all walks of life, and this could end up being a structural hardship for some people. And I think that's something that probably should have been taken into consideration. So, again, Ed, you sort of hit it already, but in your article you touch gingerly on the fact that it's floated about possibly forgiving all of these payroll taxes, but as you identified, that could be an unnecessary hit to that Social Security trust fund.
Yes, and I just don't think that's going to happen because Congress has to approve that. Both houses of Congress have to approve that. With a Democratic House of Representatives, it's highly doubtful they would approve such a thing. And if they don't approve it, whether the Senate, which is in Republican majority, whether they approve it or not is irrelevant. It has to go through both houses. It's just not going to happen.
Sure. Okay. Well, again, this was kind of a special, and Ed jumped right on it and wrote about it immediately to get it out there up on the Fed Zone. So we wanted to tackle it in this. This is one of our shorter podcasts. That's by design. This is going to make it easy for you folks to share, because good or bad, if you need to know it, Ed Zurndorfer, Serving Those Who Serve, we're going to bring it to you. We're going to talk about it because we are here to make sure things work out for you as well as they can. There are always going to be realities. This is part of that reality. So again, please, going to ask you to share it. We're keeping it short. And if you have additional questions, hit us up and ask the question at asked, ASKED, at stwserve.com. And also, while you're at our website, www.stwserve.com, click on the button for webinars. Ed has tax webinars, and I'm willing to bet, Ed, this is something you're going to mention in tax webinars for feds right now.
Absolutely, it's been added for the fall. For all the tax webinars we're doing in the fall, starting in I think the next one is in October.
Early October. Yep.
Early October, it will be mentioned, and if we do, and the next one in November and December, we will mention it. Absolutely, it's been added.
Yep. Hey, folks, again, with me deviating a little bit for a joke here and there, really wanted to stay serious about this, give you some meaningful stuff. If that money's coming in, set it aside. You're going to have to pay it back. Just understand, from that first pay on, the longest that's your money to hang on to is 1 quarter. So, it's going to be really tempting to use that for Christmas, but you're going to feel it in January based on the way it's set up right now, and we want to make sure you're in the best situation possible. Ed, I don't know how you keep up all those stuff, but I'm glad you do it for the feds, and I'm glad you do it with us. Folks, that's a wrap. Ed will be back as we continue to work together to reach, teach, and serve you. We are serving those who serve. Be sure to subscribe to our podcast on our YouTube channel and Spotify. Please remember to share it with your friends and strangers. Okay, check us out on Twitter and LinkedIn. Don't forget those live webinars. We have them every week, sometimes multiple ones in a week. Just go to the SWS website, stwserve.com. You'll see the webinar button in the middle landing page. That is Virtual Ed. He will come to you. He will come to you to teach you wherever you are. He will reach you where you are, teach you where you are. We will serve you where they are. Sign up for one, sign up for all. You can learn about stuff while wearing your bunny slippers. That's how convenient Ed's making it for you. And be sure to read Ed every month at the Fed Zone, which is at blog, B-L-O-G, at swserve.com, and also at fed-zone.com. So for Ed, the crew at Serving Those Who Serve, and me, Dan Sipe, which you learned last go-round, I now have the nickname of Danny Feds, and Ed is Eddie Z. I will say to you, good luck, Godspeed, and above all, remember, it is your Fed life, so please, please, please make it a great one, because you deserve it. Stay well, everyone. We are out.
Thank you for listening to the FedLife Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Raymond James is not affiliated and does not endorse the opinions or services of any of the quoted professionals or their respective firms. Any opinions are those of Dan Sipe and not necessarily those of RJFS or Raymond James. This case study is for illustrative purposes only. Individual cases will vary.
Neither Raymond James Financial Services nor any Raymond James financial advisor renders advice on tax issues. These matters should be discussed with the appropriate professional. Investing involves risk, and you may incur a profit or loss regardless of strategy selected, including diversification and asset allocation.
Raymond James is not affiliated with and does not endorse the opinions or services of the quoted professionals or their respective organizations.